Today, we have something a little different for you. Take a listen to this previously recorded interview. It's just too good, and we just didn't want you to miss it. Enjoy the episode, and join us again next week.
You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everyone, and welcome to the Infinite Banking Mastery Podcast. Thank you for being here. So this week, I wanted to go over and kind of continue on last week's topic. I wanted to expand on what I spoke to you about last time and go over more of the mechanics of what's actually happening when you're paying yourself with more interest than the policy or the insurance company is charging you. A lot of times this confuses people because they think, how do I get this extra interest into the policy? Because the company is charging me a certain rate, but how do I charge myself more than that? And how does that grow my system? So right now, new contracts, they have interest rates. When you borrow money, the interest rate is about 4%. There's different options around that I would explain, but really, you'd be guaranteed to never pay more than 4% on any loan with the company. And so now if you want to be more than an honest banker, but then charge yourself with more than that, more interest than that, and pay yourself back with interest to be that honest banker and make sure your policy becomes as amazing as it could be, you might want to charge yourself 8% interest on a loan with the company, or 10% or 12%. The more you charge yourself, the more you're going to have. You're going to grow your own pool of cash much faster that way. So after you've taken a loan, and then we have a conversation and figure out what makes sense for you to repay yourself, and maybe select an interest rate that you feel comfortable with and create an amortization schedule. That's one of the ways that we help create a repayment plan for you. Then we can set up the loan to draft direct from the company. They would just draft it right out of your account on a day that you select. So for example, you take a loan April 1st and you need maybe a little buffer period before you start repaying on that loan. You could tell me, okay, once we figure out the repayment amount and everything, get that all situated, you could tell me, I would like to start repaying this loan on, say, June 15th or May or July, because you get to choose the terms and you get to choose the start date. So then the company would start drafting this money. And again, this is one of the ways that a person can repay their policy. There's a couple different ways to do it. If we had it situated so that the company is drafting that loan repayment right out of your checking account on the day that you select, and if you selected an amount of interest that is more than what the company is charging you, currently 4%, and if you have a contract at 4%, that will be your guaranteed rate for your lifetime. They do make changes to these contracts every so often, not very often, but the interest rate could change for future contracts. But right now it's 4%. Okay, so then you're making your payment to the company and you're charging yourself, say, 10%. Well, the company, when you're repaying those loans, the company can only really accept back into that policy the amount of money that you borrowed and the 4% interest that they're charging. Because remember, when you take a loan, you've basically made a hole in your policy. There's an empty hole now. You've taken out some funds. And so you're able to replenish that and then pay the interest that they're charging you and also pay your premium. But we can't put too much money into the premium, remember, because that will cause the policy to become a modified endowment contract, and then it will be taxable. So if you're paying the maximum amount of premium that you're allowed to on this contract so that it does not MEC, and you are repaying the loan, where does your extra interest go? Because you actually can't fit it into this policy. If you came up with, say, a loan repayment schedule of 5 years at 10%, and you have a certain payment figured out and you plan to pay it off in 5 years, what will actually happen is that your loan to the company will be paid off sooner than those 5 years. Because since your payment is larger to account for that 10% interest as opposed to 4% interest, that extra interest and that extra payment that you're making will be going back to the company and will end up replenishing your policy faster. So your loan will be paid off faster. So you may have a loan for 5 years and maybe it gets paid off in 4 years in 2 months or something like that. And so what do you do then with the extra payments? Because you still have, say, 10 more months of payments to make. That's where it really comes down to you being an honest banker and treating your money with the value that you would any other loan. You should continue making that payment to yourself, whether you keep it in a separate banking account. You can have a different account that so you can keep track of that and account for that money. And then you'll watch that money build up in your separate account. And once it's in there, you are then able to use those extra funds, maybe to fund your paid up additions premium that year or in a future year. So, maybe you have a plan to fund your base premium and your paid up additions premium, and then maybe you're having a hard time funding that paid up additions. This can help you with that because it will start to accumulate money inside of this separate account that those funds could be used to fund the premium. Another thing you could do is when those funds have accumulated a bit, you might say, hey, I have this money accumulating in this account and I have this lump sum now. Maybe I'll use it to open another policy or to pay the paid up additions on another family member that I'm an owner of a contract for my children or my spouse or something. Maybe we want to redirect those extra funds to the paid up additions on a different contract, or maybe use it to start a new contract. One of the things is that when you're making this payment to yourself, it eventually will pay off the loan inside, and then you'll have this monthly payment that you're used to making. The smart thing would be to do with that money would be to start another contract with that payment. Or maybe your finances have changed and actually you've had a raise and you are earning more, or your business is doing super well. And that monthly payment that you were making to yourself, you're able to create a new monthly payment to another policy and make it larger because maybe you have more cash flow and you're able to start a second policy with a larger premium. Starting that second policy is what's going to expand your overall banking system, what's going to really grow you a system of policies. Because having one policy is going to be great. It's going to be guaranteed. You're going to have peace of mind knowing there's this lump sum in there that you can access for anything you need, that you can access it tax-free, that you can access it in retirement, and that's awesome. But to grow your overall banking system, you will end up having more than one policy. And so that might be one on you, one on your spouse, one on your children. Or it could be that you end up with 2 on yourself or more than that. Currently, for my family, we have 9 whole life policies. I also do have some term insurance so that I can convert it in the future as needed. I have 2 policies on each of my children, and my husband and I have more than one whole life insurance policy on each of us as well. Because when I started teaching this strategy and helping people with this, I started my own policy with as much as I possibly could fund into it because I wanted to start it as young as possible. Because the more years you have to snowball this cash and have it grow, the more years that you have for this cash to grow uninterrupted, the larger it will be in the long run. So I wanted to get something started right away, even if it wasn't my goal premium or what I would like to do over my lifetime. But then as income grew, I wanted to save more into this because I don't just want one small pool of cash that I have access to all my life or in retirement. So the more contracts that we have, that's just another pool of cash you have growing that will be tax-free and everything. And so I'd rather have a lot. I'd rather have a lot of these separate pools of cash that I have access to for different reasons. You could even categorize them for different reasons. Say, well, this is my child's policy. This is designated for my child's needs, for their first car or for college, or whatever that person might need. And maybe as your child grows up, then you help them through college using that policy, replenish it, and then maybe they're using it for a down payment on their home, and then all throughout their life, and then again in retirement. And so there's a lot of uses for these policies. So I want to have as much cash as I can have in there, guaranteeing to earn interest for the rest of my life. I just start where I could. I started where I could, and then I continued to grow them as I was able to. So at the end of the day, what's growing your system your overall system of policies is more premium dollars. That's what's going to fuel the growth of your system. Replenishing the funds when you're taking loans out and paying them back, a very important factor, and it will replenish the funds so that you have them there to use again for your next need, for your next investment. Once you retire, you want to have funds there. So you don't want to just deplete out all the funds and borrow them for all sorts of things and then never repay them, because then they won't be there in your retirement years, or you won't have the full account value that you can see. You won't have the full amount expected by the time you're retiring if you have a big chunk borrowed out. So that's why it's important to pay yourself back. And if you're paying yourself back with interest, the loan gets replenished faster and you end up having extra funds to start new premium with or to fund a paid-up additions rider on an existing policy. Occasionally, I'll have people say to me, well, isn't it just easier if I just save up my money and pay in cash and buy things in cash and then I don't have to worry about paying myself back and all of this? Well, no, because when you save up your money and pay in cash, you are handing that money over to someone else and you will never earn on it again. The place that you just sent the money or that person is the one who's going to be able to earn on that money, or they will do with it as they please. But you are losing the earning power of those dollars whenever you hand them over and pay in cash. And if you think about it, when you're saving up to pay for something in cash, you have a goal in mind, you have a savings account. Maybe you're trying to save $300 a month or $500 a month or $200 a month to your vacation savings and $200 a month for some other sort of savings, and you have it all planned out. But the action is still the same. You are still moving money from your checking account to your savings account, amount you figured out, amount you came up with that you decided would work for you and that you'd be able to save each month. And so you select that number and then you move it from your checking to your savings. And that action of moving that money from checking to savings is no different than moving that money from your checking to your life insurance policy. You're still taking the money from your checking and moving it somewhere else. Now, once those funds are drafted from your checking account and moved over to your life insurance policy for a loan repayment, they become readily available. They're basically readily available for you to use again. So it's not like they're just disappearing. So it's the same action, moving the money from checking to savings to create a pool of cash to go buy something in cash, or moving your money from checking to your banking policy to replenish a loan so that you can buy something else later. And all of that is the same. You still have money moving from your checking to somewhere else that you're not choosing to have access to because it's being saved for a purpose. And you can use your life insurance policy as your emergency savings holding tank if you want to. I mean, if you prefer to have it in a bank account, fine. But for me, my emergency savings is in my whole life policy. So if I need money for any reason, I have to go to my life insurance policy. And frankly, I trust it a lot more to house my money there. And so I'm good with that. It takes a few days to move it. Once I make the request for funds, it takes about 3 to 5 business days to move into my checking account. But I trust that a lot more than having a sizable amount of savings in my savings account at a bank. Okay, so if you're interested in learning how IBC could work for you and you'd like to have a conversation to see how this strategy might be awesome for you, and this topic is overall a little bit confusing, I would love to explain in more depth. Reach out to me at Valerie@alphaomegawealth.com. I have some visuals to help you understand. We can get through it. And then once I have these visuals and we have a conversation, I'm quite sure it will be much more clear. I would love to connect with you. So please reach out if you'd like to connect and learn more how you could do this for yourself and your family. I hope that you have a great week. Take care.
This is thepodcastfactory.com.